right. Good morning, everybody. Good morning, all you wonderful melon heads out there, and happy Tuesday. Today's August 15th, 2023. Top story this morning, the ratings agencies. We've got Fitch is making the news again. After downgrading the U.S. credit rating, was that last week or 2 weeks ago? Who's keeping track? Everybody's getting downgrading. Fitch is back in the news this morning, threatening to downgrade the entire banking sector. Or the words they used was the bank operating environment. Hate to have your operating environment downgraded. Boy, it's a nice operating environment you get there. Shame somebody were to downgrade it. Problem is, if Fitch does that, it'd be the second time since June that they downgraded the operating environment. And that would mean that the operating environment would be downgraded below the ranking of several of the operators in that environment. And you can't have that. So if Fitch were to downgrade the whole banking sector, it would force them to downgrade several other banks. Because you can't have a bank rated higher than this whole sector is rated. Well, that's some big names. JP Morgan, Bank of America. What would happen if JP Morgan got their credit rating downgraded? I don't know. We might be about to find out. So right now, bank stocks not looking so good this morning. Virtually across the board, the banks are down this morning. And why is Fitch doing this? Why is Fitch threatening another downgrade? Probably because all the problems that caused banks to fail back in March are still there. They didn't fix anything, guys. They made the problem worse, actually. We've had 3 rate hikes since the banks started failing in March. And the banks failed because of rate hikes. There's been 3 more. It's not good. And we've still got the possibility of another rate hike on the table. Probably not in September. The market is saying it's a near certainty of a pause in September. That wouldn't surprise anybody. But that November rate hike is still on the table. And well, we got some data this morning that says that November rate hike might actually be more of a reality. Retail sales came in, and they were higher than expected. Actually, adjusted for inflation, they were almost positive. Not quite positive if you adjust for inflation. But they were higher than expected, which means the odds of a Fed rate hike, remember, we're in that twilight zone where good economic news is bad news for markets because good news means the Fed's going to turn the screws to the economy. And bad economic news is good for markets because bad news means the Fed might ease up. Well, this morning we got good news, which is bad news. You with me? You follow me? I'm pretty sure I just lost myself there, but we're moving on. And that's not just in the U.S. that happened. We also got good news is bad news in Japan last night with their GDP came in at 6% year-over-year growth. That's got everybody saying, well, the BOJ, there's the all clear. They can ease off the yield curve control policy, let rates rise further. Well, that's a risk to the Japan, the yen carry trade that we talked about in the channel last week. And we also got some actually pretty decent news out of the UK last night. Basic wages in the UK are rising at a pretty high rate, actually the highest rate they've ever risen. Of course, the problem is they're still rising at a rate slower than inflation. Don't expect Andrew Bailey over at the Bank of England to understand that or to realize the plight of the common people continues to get worse. No, Andrew Bailey over at the Bank of England is going to see people's wages rising at a faster rate and say, oh, no, we can't allow that. And he's probably going to raise rates again, even though real wages are still in decline in the UK. So again, good news, people making more money is really bad news for those people because it means the Bank of England's going to raise interest rates and put them out of work. And speaking of central banks, we got more bad news out of China. And in China, bad news actually is bad news. Keep up. The PBOC lowered interest rates. Big surprise last night. The People's Bank of China, that's the Chinese Fed, they lowered their interest rates. We got a lot of economic data, industrial numbers, retail numbers out of China, all still growing, but very slow. Low single-digit growth. And low single-digit growth in China, where almost all data is viewed through the lens of a communist party that's going to tell you things are good no matter what's happening, that's not very good news. And China just decided, you know what, our youth unemployment rate is too high, not going to report it anymore. Whoops. Youth unemployment has been a scourge in the Chinese economy recently, reaching as high as 21.3% last month. It was expected to rise dramatically this month. Well, youth unemployment is not really happening if we just don't report the data, right? It's kind of like when they banned the use of the word deflation from their economists last week. Well, if we just don't let the economists say it, then it's not really happening. That's how economic data gets reported in the Chinese Communist Party. So we've got central banks once again making a mess in markets today all across the world. And with that, we are going to shrink my beautiful big melon of a head. And won't you please inflate that like button while we're here, guys? We do this every morning. And if you're new to the channel, won't you please hit that subscribe button and stay with us for a while? We've got the CNN Fear Greed Index this morning. It's at 62, another tick down, just a little bit lower. It was 63 yesterday. Again, fear slowly returning to the market, but not really. I'll be honest with you. The comments in the video I posted last night about Michael Burry and his big short on the bet, which, by the way, I had to pull that video because I made a mistake in it and I had to repost it. But in the first draft of that video, the comments were overwhelmingly bullish the market. Almost everybody in unison was saying Burry's going to get burned. He's too early. The S&P is headed to all-time highs. Gee, do you think maybe Michael Burry has heard that before? This market, the bullish sentiment in this market is so misguided. Everybody's saying the Fed is going to print and take the market to all-time highs. What everybody doesn't realize is that the Fed wants the crash. The Fed is trying to create the crash because the Fed wants to put people out of work to prevent wage spiral inflation, which is that Keynesian boogeyman that lurks in every closet and behind every shadow. It doesn't exist, but they fear it. And they're going to make sure you don't get a raise. And that's why good news is bad news. And that's why every time there's a good economic data point comes out, stocks go down because they know the Fed doesn't want good economic data. The Fed is not going to take this market to new all-time highs. Looking over the S&P 500 this morning, down 27.8 points or 0.62%. The Dow futures are looking, big down day in Dow futures at the moment, down 265 points, projecting an open down 0.75%. The Nasdaq's faring a little bit better, set to open down 66 points or 0.43%. We've got the U.S. dollar is marginally weaker this morning, still over 103, clinging to it, down 18 basis points at 103.01. And looking over at the bond market, watch those yields, guys. Watch out for those interest rates. 30-year Treasury is up 3 basis points, yielding 4.3%. The 10-year at 4.21, that's up 3 basis points. The 10-year is approaching those prior highs seen back in October, November of last year. It's not a good thing for the economy. The 2-year just below 5%, yielding 4.98. That's up 2 basis points. And even the 1-month is getting in on the action this morning, up 1.5 points, 5.4% on the 1-month Treasury. And check out the yield on the 10-year Treasury, guys. This is going back to last summer, about July, August of last year. Here's the highs from October and from November, and look at where we are right now. We're just off the highs today, but we are challenging those highs last seen in October. The economy does not like this. And again, this overly bullish attitude that permeates the market right now with interest rates higher than we've seen in, 15 years. There's just too much optimism in this market, guys. It's way overhyped. And again, the contrarian trade, when everyone and their brother is saying stocks are going to all-time highs, probably means it's time to get out of stocks. Looking over at the commodities board, we got gold not doing so good this morning, down 785 or 1,936 for December gold futures. September silver futures trading at 22.57. That's down another 13 cents or 1.11%. And September crude oil futures for West Texas Intermediate at 81.54. That's down another dollar or 1% for oil. So commodities heading lower this morning. Check out the gold chart, guys. This is the 200-day moving average on gold. And looks like we've reclaimed it right now, but keep an eye on that. We were below it this morning. Break below the 200-day moving average would be a very bearish sign for gold prices. Just hanging on to that level here. Do we get a bounce and head higher or a breakdown and lower? Let me know what you think down in the comments. But here's the big story this morning. Fitch warns it may be forced to downgrade dozens of banks, including J.P. Morgan Chase. Fitch Ratings cut its assessment of the banking industry's health in June, a move that analyst Chris Wolf said went largely unnoticed because it didn't trigger downgrades on banks. By the way, fun fact, Chris Wolf, that was the name of the character in the movie The Accountant, Ben Affleck's character, who was named after a very famous mathematician who had autism. Christopher Wolf was there. Christian Wolf was the name of that guy in that movie. But another one-notch downgrade of the industry score from AA- to A+ would force Fitch to reevaluate ratings on each of the more than 70 U.S. banks it covers. If we were to move to A+, then it would recalibrate all our financial measures and would probably translate into negative ratings actions, Wolf said. And I just want to get down to these two paragraphs because this is why the banks are worried this morning. The problem created by another downgrade to A+ is that the industry score would be lower than that of some of its top-rated lenders. The country's two largest banks by assets, JP Morgan and Bank of America, would likely be cut to A+ from AA- in this scenario, since banks can't be rated higher than the environment in which they operate. By the way, Bank of America, with their unrealized losses of more than $100 billion on U.S. Treasuries, why haven't they been downgraded already? Question for another day, I suppose. And if top institutions like JP Morgan are cut, then Fitch would be forced to at least consider downgrades on all their peers' ratings, according to Wolf. That could potentially push some weaker lenders closer to non-investment grade status. And guys, this warning from Fitch this morning has got banks across the board worried. Pre-market, we have got the KBE, that's the Spider S&P Bank Sector ETF. That's down 1.25% this morning. We've got the regional bank ETF is down 1.8% this morning. That's KRE is the regional banks ETF. That's down 1.8%. JP Morgan down 1.4% pre-market on this news. Bank of America down 1.65%. And then some of the smaller banks like Western Alliance down 4.6% on this news. So banks pretty much across the board are selling off at least a little bit on this warning from Fitch. Take note of that, guys, because, again, it hasn't been that long since the banking crisis in March. The issues that drove those bank failures have not been resolved. They have been made worse, even though the Fed rolled out their bank term funding program as a way to prop up liquidity in the bond markets. The underlying problem of unrealized losses on the balance sheets at these banks is still there, and you've still got deposit flight, people pulling their money out of banks where they're not earning any interest and putting them into short-term U.S. Treasuries or money markets where they can get 5%. So the weakness in the banking sector that drove that crisis in March is still there. Now let's talk about some economic data that came out this morning in the U.S. We had month-over-month retail sales came out at 0.7% up. That's versus a consensus of 0.4%, so better than expected retail sales. We also got the year-over-year number in retail sales, whereas that one came in at 3.2%. That's versus expectations of 1.5%. So retail sales better than expected. And here's the year-over-year number, up 3.2%. Now, guys, I just want to mention it's still below the CPI, still below the rate of inflation. So these are still negative real retail sales. The retail number is not adjusted for inflation, but it's not as negative. It's just barely negative. It's pretty much flat. And I would add that it's a little bit higher than some of the recent months. We've had some pretty lousy reports from April, May, and June. So this July number, pretty good, 3.2%. At least, I don't want to say it's pretty good. It's not terrible. All right. And if you were expecting terrible, then this is a beat. And I think the market was expecting terrible. So 3.2% year-over-year growth in retail sales. That's pretty good. And shout out to Gregory Dacko on Twitter, who put this tweet out saying, where is retail doing well? So these are all month-over-month numbers. Online retailers up 1.9%. They saw the biggest gain. That means Amazon is capturing market share. Sports up 1.5%. Restaurants and bars up 1.4%. That's people spending money on travel and experience. Clothing up 1%. Right? Apparel's been noticeably weak this year, so seeing clothing doing pretty well, maybe that's a good sign for Target and Walmart earnings later this week. We'll see when they report in the next few days. Food up 0.8%, health up 0.7%, building materials up 0.7%, gas up 0.4%. Now we got a couple of big ticket items in the negative. We got autos, negative 0.3%. Electronics, negative 1.3%, and furniture, negative 1.8%. So it's not all unicorns and rainbows across the board. We do have some sectors showing weakness. Now, another thing I want to point out is that we got export and import prices for the U.S., and they were deeply negative. Again, export prices year over year in the United States decreased 7.9% from July. That's after a negative 12% number in June. So export prices in the U.S. are still heading lower. Now, I would add they are falling slower now. All right, we had a big 12% drop in June. Now we're only getting a 7.9% drop. The market was expecting a much bigger drop, but again, this is still a negative number. And by the way, export prices were expected to come in at negative 14.1. They came in at negative 7.9. So even though this is a bad number, it's a beat because it's not as bad as they were expecting. But there's your deflation right there, folks. Export prices continuing to fall. Imports not doing any better. Import prices year over year in the U.S. increased to negative 4.4% in July from negative 6.1% in June. So same story, still negative, still going down, but going down less than they were going down a month ago. Is this a dead cat or is this a change in the trend? We still don't know. We need more data for that. And once again, this was a beat because the market was expecting import prices to fall 6.5%. Instead, it fell 4.4%. So we are still seeing deflation in global trade in exports and imports, although not as bad as some people were fearing. Other data we got this morning, the Empire State Manufacturing Index, that's probably the one data point that was really bad this morning, came in at negative 19. The market was expecting negative 1. So that's a big decline. Again, this is measuring production in the New York Fed region, negative 19. Anything below zero is contraction. Anything above zero is expansion. And you can see Empire State Manufacturing Index, it's been in negative territory for the better part of the last year. Now let's talk about China, because we had a lot came out of China recently. China cuts rates by most seen since 2020 as economic woes deepen. PBOC lowers the one-year policy interest rate by 15 basis points. And economic activity in July weakens as retail sales growth slows. So while all the other central banks in the world, the Bank of England, the Bank of Japan, the European Central Bank, the Federal Reserve, Australia, Canada, all the Western central banks are still tightening, PBOC is loosening now. They're trying to spur credit creation. They're trying to jumpstart their economy, which is in free fall over in China. So this last-minute rate cut that nobody was expecting, this is not a good news story. This is showing increasing levels of desperation from the PBOC. China's central bank unexpectedly reduced a key interest rate by the most since 2020 to bolster an economy that's facing fresh risks from a worsening property slump and weak consumer spending. The PBOC lowered the rate on its one-year loans or medium-term lending facility by 15 basis points to 2.5% on Tuesday, the second reduction since June. All but one of the 15 analysts surveyed by Bloomberg had predicted the rate would stay unchanged. So, unexpected rate cut, to put it mildly. Now, I want to talk about some of this economic data that came out because it was pretty bad here. And keep in mind, this is all filtered through Communist Party censors, so take from this what you will. Industrial production increased 3.7% in July. That's lower than the 4.3% that was expected. Retail sales growth was 2.5%, worse than the 4% that was expected. Gross and fixed asset investment weakened to 3.4% in the first 7 months of the year. That's below the 3.7% that was expected. Property investment contracted to 8.5%, worse than the first 6 months of the year. The urban jobless rate rose from 5.3% versus 5.2% in June. So all of this data showing slowing economic growth in China. And again, you have to assume, because of the way the Chinese Communist Party operates, that all this data is skewed upwards to cast them in a more favorable light. And even still, it's not that good. And probably the biggest story that's probably going to make everybody more worried, China halts youth jobs data, stoking transparency concerns. Transparency concerns in communist China. Say it ain't so. A fifth of young people in China were out of work in June, and so China's just not going to report the data anymore. It's not bad news if we don't let you report it. China suspended publishing data on its soaring youth unemployment rate to iron out complexities in the numbers. Yes, got to avoid those complexities in the numbers. Get that iron out, flatten those things right out, put a little steam on it. We'll make that youth unemployment look real good. Fanning investor fears about data transparency in the world's second largest economy. The National Bureau of Statistics didn't release a figure for the jobless rate for people aged between 16 to 24 in its July economic activity report on Tuesday. Youth unemployment hit a record 21.3% in June, with the Bureau last month indicating the figure would probably increase. Well, the figure can't go up if we don't let you report it. And I just want to add here, China has, over the past year, limited access to corporate data, court documents, academic journals, and rated expert networks serving businesses, hampering investors' ability to assess the economy. Officials have also been downplaying economic risks like deflation, with some Chinese-based analysts saying they were instructed by regulators and their companies not to discuss the matter publicly. So nobody is allowed to tell you how bad the data is in China. Nobody's allowed to tell the truth about how rapidly the Chinese economy is deteriorating. Now, If you're a foreign investor thinking about putting money into a Chinese project and you're reading stories like this, does that make you want to send your money to China? No, it does not. And China's economy desperately needs foreign investment right now to try to kickstart demand for the yuan, which is plummeting, and to try to get money to come in to finish all these housing projects that need to be done. So China's shooting themselves in the foot here. Don't expect them to realize the error of their ways. And guys, if you had been at the Stock Pulse Silver Symposium last year, none of this would surprise you because my whole talk at the Silver Symposium last year in Spokane, Washington, was all about the mother of all asset bubbles, the China real estate crisis, and how it was only a matter of time before it collapsed. Even though it had fallen from the headlines by that time, the message was the bubble is the biggest asset bubble in history. Nothing else comes close. It all boils down to the one-child policy that caused it. And well, this story's going on right now. Would not surprise you if you had sat in on that talk. And the next Silver Symposium is just 45 days away. There's a link down in the description below. That's an affiliate link. If you use that, you'll get 10% off your tickets. Come out and say hi. Let's have a drink and let's talk economics. Few more quick ones, guys. UK basic wage growth hits record, adding to Bank of England's worries. This is another case where good news is really bad news because central banks can't let the plebs have any good news. Basic wages in Britain hit a new record growth rate, figures showed on Tuesday, adding to worries that the Bank of England about long-term inflation pressures, even after 14 back-to-back increases in interest rates. Official data showed some fresh signs of cooling in the jobs market, with the unemployment rate unexpectedly rising to 4.2% from 4%. That's the highest in the 3 months since October 2021, climbing more quickly than the BOE had forecast. So we've got wages are rising fast, but unemployment is also rising. Now check this out. This is average wages excluding bonuses, otherwise known as basic income in the UK. It increased 7.8% year over year. And you can see this number has been steadily rising. But remember, guys, inflation in the UK, their CPI rate is 7.9%. So people are still getting negative real cost of living adjustments. Their wages are rising slower than inflation, so the plight of the average person is getting worse despite record wage gains. But everybody's saying, oh no, the wages are going up. Andrew Bailey over at the Bank of England is going to raise interest rates and put people out of work. And look, guys, this is what wages have done in the UK going all the way back to 2013. Yes, they are rising. This chart looks like the average person is doing great. But keep in mind the cost of living is risen faster. Don't expect central bankers to keep that in mind, though. Their goal is to make sure these wages don't go up, because they think if wages go up, people will spend that extra money, which of course they will, and they think that will contribute to inflation. And it won't contribute to inflation. It'll just mean that the average person doesn't have to suffer a decrease in their standard of living because of money printing that made the ruling class even more wealthy. Don't expect a central banker to come to that conclusion. And lastly, same thing, Japan's economic growth surges on strong exports and tourism. Japan saw 6% GDP growth in their last quarter. That was reported last night. And of course, that has got fears of rate hikes from the Bank of Japan. Bank of Japan engaged in yield curve control. They've been tweaking that policy. They've been widely considered to be in the process of stepping away from that. These big GDP numbers out of Japan last night will give them probably the runway they need to ease off of yield curve control again. Keep an eye on that yen carry trade. It could cause problems in the economy. And I have a few thank yous I have to send this morning. I saw a few of you guys come in. What's going on, Mr. Zarkos? Thank you, sir, for the super chat, the support of the channel. From a European bear to a U.S. bear, let's unite and make tons of dollars and euros. Bears of the world unite. Thanks for your videos, detailed and informative. Thank you very much, Zarkos, from one bear to another. I appreciate that, sir. This from this perma bear to you, the European perma bear. Thank you. I appreciate that, sir, very much. And thank you, Grandpa, for your super chat, sir. He says, are we looking at a 2008 45% decline or an 80% 2001 decline when this hits? You know, I think if the central banks take no action, I think you can back up even further. If the central banks do nothing, we're looking at 1929. Not 2008, not 2001, 1929. That's if the central banks do nothing. Now, the central banks probably won't do nothing. All right, almost certainly they won't do nothing. They don't know how to do nothing. They see an economy trying to find its natural equilibrium, and they just say, oh, we can't have that. QE, QT, rate hikes, rate cuts, whatever they have to do just to interrupt the natural order of things. The question is, how much pain do they let us go through, or should I say, how much pain do they put us through before those printers come on, before those rate hikes start again? Now, everybody keeps saying something like they won't do that or they won't let that happen. And what people need to realize, here comes the tinfoil hat, to all the people saying the Fed is going to save the market, it's going to ride to the rescue. They, the Fed, the ruling class, they are doing it on purpose. They're interrupting the inflation cycle. The inflation cycle, first it hits the money supply and it grows. Then asset prices go up and they get more wealthy. Then consumer prices go up and you get poorer. And the last thing in the inflation cycle to happen is wages rise. That's just starting to happen. See all these labor disputes and the UAW wanting a 40% raise and the UPS strike. Now they are turning the screws to the economy to prevent those wages from rising. And that way the wealth gap grows and their power goes up and you get poorer. So to all the people saying they won't let that happen, the Federal Reserve will ride to the rescue and save everyone. The Fed is doing this on purpose. It's not that they won't let that happen. It's that they will make that happen on purpose. The question is, when do they stop it? When have they decided we've had enough? And that's the trillion-dollar question. Nobody knows that. So will it be 2008? Will it be 2001? Or will it be 1929? It's up to they. It's not up to you. It's not up to me. It's up to they. And nobody really knows for sure. So thank you very much, Grandpa. I appreciate the super chat, sir, and the support of the channel. And I am remiss, guys. I have something. I missed my boy, Jose Orozco, yesterday. He gave me a super chat on the live stream, and I did not put it up on the screen. Jose, I apologize, sir. He said, cheers, Jack. Happy back to school day, and God bless the Melonheads. Thank you very much, Jose. I appreciate that, sir. Jose Orozco, the keeper of the Buc-ee's Corn Nuggets. I got a chance to meet Jose when I was in San Antonio with the Ninja last summer. That was a great time. Real swell guy. Jose, I apologize for missing your super chat, sir. I got wrapped up in the China story yesterday, and I forgot to circle back. All right, guys, I just want to say thank you, everybody, for your super chats, your support of the channel. Thank you to my Patreon supporters. Appreciate everything you guys do. Link down below should you feel so inclined. I'll be posting a link to our Zoom call for tomorrow. I'll post that today. Looking forward to talking to you guys tomorrow. And also, hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.